Hey guys, it's Walker Dybel, author of Buy Then Build and creator of the Acquisition Lab. Today we're going to talk about bringing investors into your deal, right? And I know that this is a somewhat confusing topic. I was talking with a member of the Acquisition Lab last week, and he said that he even had some interest of investors coming in, but didn't even really know how to address it. And so it occurred to me that this is a really interesting topic, and there's a lot of different ways to define it. And so I'm hoping with this video to add some clarity to the different ways that people think about valuation on bringing in an investor, okay? First, I want to talk about why would we want to bring in investors? Well, the concept is that let's pretend that from here to here is your deal, okay? This is how much total money you need to close on the deal, okay? This is 100% of the deal. Now let's say that your purchase price plus working capital. So depending on the size of your deal, your working capital might be included in the purchase price, or it might be above in addition to the purchase price. Those two combined are going to give you enterprise value, okay? So this is the total enterprise value of your deal, EV, okay? Now, a lot of people will come in and say, let's just say this is, $100, okay, $100. And you're gonna come in and say, hey, I wanna put the minimum amount down, and so I'm gonna put down 10%. And this 10% would represent, in this case, $10, okay? If this isn't interesting, let's make it more interesting. This is 100 million, okay? We're just gonna add some zeros, make it a lot more interesting. So in 10 million, okay? So we need 10 million in cash in order to buy this, $100 million enterprise value company, okay? So we need to get this 10 million, and this 10 that's going in to buy it, assuming all the rest of this is debt, is going to be the cash value, okay? That's the cash value. So you've got your enterprise value up here and your cash value down here. Now, it's important to take a minute and kind of sidebar over how you think about how much you want to put down, okay? Because you might be bringing in investors to come up with this 10 million, or maybe you have the 10 million and you're just thinking to yourself, hey, I want to come in at, more of like a 40 to 60% cash value to enterprise value. And the reason for that is the following. When you you can finance a deal with debt or equity, okay? Those are really your only two options, okay? Some people like to talk about earn-ins and things like this, and that's fine for sub-$1 million companies, but it's not how the private markets work. So the thing is if you finance with debt on this and have a large percentage of debt, what your driving financial factor is going to be return on investment, okay? And what that means is that if you want to get really high ROIs so I bought a company, held it for 4.5 years myself, and actually got a 52% compounded annual growth rate, right? It makes me look like a genius, okay? And the thing is it's all about ROI. But with that particular company, I'll be the first to tell you, there were a lot of sleepless nights, okay? Owning a business is hard and it's challenging, and when you come in with a lot of debt, if things aren't great every single month, then you're gonna be losing some sleep, okay? And so the thing is that like, if you wanna focus on sleep, it's really cash flow, okay? So the more equity you put in, the more cash flow you have. And I'll use green because we're talking about money, but as you increase the amount of equity, okay, you come up here into safety. You've got much more of a safe place to live and be. And then if you increase your debt, you actually are increasing your risk. Okay, I think it was Warren Buffett who said when the tide comes out, you can see who's been swimming naked. Right, and what that points to is that when everything's fine, having a lot of leverage is really good for you because you can actually make a lot more money financially, right? But private equity has learned on a couple different occasions that the tide sometimes goes out, and so they like to come in with 40 to 60% equity. Now, it's 40% equity when they get a good price, and it's 60% equity when they know they're overpaying. They're totally willing to overpay in certain instances because of strategic fit or because they need to deploy capital or whatever it might be. But the important thing to know is that despite having $2 trillion in dry powder, liquid cash right now, they still want to put 60% debt on deals. And the reason why is because that's where you get a lot of your return on your investment, okay, is in the equity buildup portion. So you might want to be bringing in, whether it's this amount or increasing that amount. And if you don't have that money, whether it be to this level or that level, investors are where they come in, right? So the first thing I want to talk about is, I think the default setting is a lot of people like to think about, okay, the enterprise value is 100 million, and so I'm going to charge a pari passu equivalent to the enterprise value to the investor, okay? And there's a couple of reasons why I don't think that's actually the right answer, and the reason for that is, number one, when you are a minority investor, you completely lack control, and so whoever is going to be the majority investor is going to, or majority owner is going to be the person in control of that full amount. And there needs to be a discount applied for lack of control, okay? The other concept behind enterprise value is there's sort of an execution or transferability risk. So if you're the operator and I'm investing in your company, for me, there's additional risk. So you're buying this company, okay, and I'm just kind of coming along for the ride, okay? Well, if you jump in and screw it up in the first year, that adds risk to me. And so, there needs to be a bit of a discount off of the enterprise value. And the final thing that really drives the nail in the coffin for me is that if you come in at enterprise value, then what that means is that you as the investor are not getting any of the benefit of the equity buildup on the debt, okay? So if I come in at 10 million and you come in at 10 million and I sell you 10% of the company at 10 million, but then I get 90% of the company also for 10 million, then as the equity gets built up, I get all of the benefit of the leverage, right? So it completely eliminates the ROI, the benefit of the leverage component to the investor, okay? And so that's why enterprise value often will not make sense. Now, if you're two partners going in on a deal and you're going to operate it together, yes, enterprise value all day long, right? But particularly, let me get to that. I was going to say particularly when they are both signing the personal guarantees on the debt or whatever. And I'm assuming there's personal guarantees at some point on this debt, okay? So then you talk about the cash value. Now, this is interesting. I've seen a couple of people out there saying, listen, we want to back investors, but we want to invest in them at the cash value, meaning, hey buyer, you only need to come up with $10 million to buy this company. So what we're going to do is, we're going to give you $5 million and then we're going to take half the company. Well, that is the opposite of the enterprise value and not okay in my book. And the reason why is because they are getting complete benefit of the equity buildup and the same as the operator, but they're not taking any of the downside risk. In other words, every investor I know, let's say there's an SBA deal on this, and I guess I made the numbers too big to come up with that. So let's take it down a notch. Okay, this is $1 million company, and we're putting in 100,000. Okay. Let's just roll with that. I don't want to complicate it. So we're going to buy $1 million with 100,000 in cash down, and then a $900,000 SBA loan. Okay. No investor in their right mind wants to come in at 20% or more, and the reason why is because they have to sign the personal guarantee on the SBA note. Okay. And so the thing is that, like, if you as the buyer, as the entrepreneur, the person that's going to go in, day out, and take all of the risk associated with the personal guarantee on the debt, then there is no version of reality that investor should be coming in at the cash value, okay? Let's talk about, in traditional search funds, there's a concept called the step up, okay? And this is starting to get a lot closer to what I think is the textbook right answer, but it's applied somewhat differently. So think about it like this. if you're a search fund, what you're doing is you're raising money just to go search. That's it. And you say, listen, I'm going to quit my job, but I've got expenses, and I'm going to run around and look for a business to buy for 12 to 24 months. There's not a lot of them out there, but they're increasing in popularity. And I think last year there was over 100 of them formed in the country. 37 actually bought a company, but keep in mind there's about 400,000 lower middle market transactions every year, so it's not even a percent. Okay, but the concept is interesting, and so if you raise money for a search fund, you say, okay, I need, pick a number, $150,000 a year, and so what I'm going to do is I'm going to divide it into these $33,000. Sorry, let's make it $30,000 tranches, and everyone can invest $30,000 to fund my search. Now, what do they get for that? They get two things. One, they get a step up in value. So that $30,000, no matter what company that searcher ends up buying, you get a step up of the $30,000 in equity value. So the most common I've seen is a 50% step up. So I'm going to give you $30,000 a search. So 150% of $30,000 is $45,000. So no matter what company you buy, I get $45,000 worth of equity when you go to close, okay? That's called a step up. The second thing that they get is the option but not the obligation to actually invest at a discount of the full deal, okay? So they get to choose later once you actually see the deal. And this concept of the step up, I think really starts to point at the fact that, hey, I'm sort of funding you early, so I'm going to get some piece, but it's a low dollar amount that makes a lot of sense to large institutional investors that don't, $30,000 isn't meaningful, or it's meaningful, but it works in a portfolio. Let's not go down that rabbit hole. But the point is, I think that, you've got this transferability risk, you have this operating risk, and you have this equity buildup that the investors need to get access to. So if you were to ask me, like, Walker, what is the right answer for this? I think that every single deal is different, which is what makes all this private market hard to navigate. But the thing is I think that the default setting in most situations should actually be a discounted enterprise value. And the reason for that is that they shouldn't get equal. A minority investor should not get equal access to the benefits of the debt as the core buyer, because they're not taking on the hard risky part of the personal guarantee on the debt, and they're not taking on the hard work of actually running the business and growing the business, okay, and keeping it viable and all of the things that come with being CEO, okay. And so if the CEO gets a better deal, okay, they just should, because they're the ones doing the work. Now, so discounting off of enterprise value is something that will get some of that equity build-up benefit to the investor, but it also is there to adjust for the transferability risk and operating risk of that buyer. Okay, so what is that percentage? I don't know. I don't think that there is a right answer to that question. I think it's all negotiable, right? But I can tell you that people who are looking to buy in the lower middle market are really going to be looking for at least a 25% return on their money over time. And so you could make a pretty strong argument that 30% discount off enterprise value is way too high, and that 10% might be way too low. And so settling in somewhere in the 15 to 20% discount seems to make a lot of sense to me. So there you go. Hopefully this information will help you navigate your deal and how you think about investors moving on. So remember, if you are an entrepreneur, do not sell to a minority investor at your cash value. And keep in mind that selling them at an enterprise value is probably giving you a little bit of an outsized return and not necessarily compensating that investor for the risk that they're taking on you.